markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Welcome back, everybody. Thanks for being here. On this episode, I speak with part-time Bollywood DJ, full-time equities trader, Nishant Porbanderwalla. For the past 12 years and ever since leaving college, Nish has been a proprietary trader at Kershner Trading Group. Kershner is a firm in Austin, Texas, founded by Andy Kershner, who appeared back on episode 128. Nish was very open in talking about the ups and downs he's endured throughout his career, including real numbers and the psychological challenges. Nish also tells an incredible story from trading the flash crash of August 2015. Although it was only a very short moment in time, it's a perfect example of what happens when experience meets opportunity. From listening, you'll also get insight to the strategies Nish has traded and still trades today, and you'll pick up some general thoughts of his on what it takes to perform well as a trader. I thoroughly enjoyed this conversation, and I think there's some great lessons to be had here. If you feel the same way, please share this episode with your friends and followers. And if you notice any occasional background noise during the course of this episode, it's just the squawk going off in the office as Nish did the podcast from his desk right after the close. But I think it adds to the vibe. Here is Nishant Porbanderwalla for episode 174. Probably a good starting point for this would be to actually talk about how you got into prop trading, because I'm interested to hear how you landed up there, because if I remember correctly, you actually wanted to be a mutual fund manager.
Yeah, that's correct. But you never get what you want. And I was out of school, and I kind of applied. Actually, Kershner Trading came to the business school at UT, which is where I studied. And I went and attended one of the seminars, when they come to hire candidates. And I kind of liked it. But at that time, it was 2006, 2007. And there was a lot of cold calling going on. Where you call people and you ask them for money, and I didn't want to do one of those things. So when I met with them, and I met with Andy, and he said, "Why don't you come to the office?" And I was like, "Fine, let me go check out the office." And I came to the office, and I realized that this is legit. Like, people are actually trading, and they're trading for themselves, and it's a proper prop firm where you're not calling and cold calling other clients to gain their business, So I was like, okay, this is nice, this is cool. And I was always interested in trading. Mutual funds, when you get out of college, you don't have that much knowledge of anything. You just want to be in trading stocks, and you just thought mutual funds is the only way to do it. So when I came, I saw the office. I liked everything, and I was like, "How do I get involved?" And they said go to your Series 7 and 56 and 55. I think 55 Series 7. I don't remember now. It's 12 years ago. But anyways, I went and did all that, and got on the floor. And then there was 2 weeks of training, and finished my training with them, and then I was on the floor, and then started trading slowly. The way Kershner works is that they have a coach assigned to you. So I was trying to learn what my coach was teaching me, and that's how I started.
Okay, yeah, it's funny you said that at the beginning there, because prop trading is almost like the direct opposite to anything client-facing, because there literally are no clients.
You're absolutely correct, but I think I didn't have that much knowledge to know really what prop trading was. All I did was just to handle my dad's brokerage portfolio and buy stocks and sell stocks and things like that. So I was interested in stocks. I just didn't know there was a company where who gives you money to trade on their behalf. So I thought mutual fund is the only way to do it. So yeah,
yeah,
I was just naive.
No, of course. It's not really one of those things you sort of know about unless you're in the know, if you know what I mean.
Absolutely. Yeah, you're correct.
So tell me a little bit about how it worked with your coach. What was the arrangement there? What sort of things were you learning? Like, how'd you get started?
So my coach was Matt Oglesby, who was a trader, and he was a really nice guy. And he kind of shared. And one of the things that Kershner is really good that people share their stuff. They share how they make money, which very less people will really do. But that's one of our mottos at KTG is that the more you share, the more you learn, and it all comes back in a circle. Where if I'm learning something new, like I share that with my coach. So, anyways, when I came on the floor, he taught me. At that time, we were playing this U-court, sorry. And the U-court was basically, we would see a big order come on the New York Stock Exchange on the NYSE through a specialist, and he would kind of halt the stock for a small period of time, saying, "Listen, hey, I have 40,000 shares that needs to be sold. Do you want to be the buyer? And if you want to be the buyer, I'll give you a price improvement than what the market is trading at that moment." So a big order would come in. We would start putting our orders out, and then we would all get one price. We would get that price from New York, and then we would flip that to the electronic exchanges like Arca and INET, and try to make an ARB trade basically. So let's say if someone is coming at $33, wants to sell 30,000 Exxon at $35, they would sell that. I would buy that at 35.01 or something, but the market is still trading at 35.25. So I would buy, a couple of thousand and sell it at 30.25 and make my 20 cents and get out.
So how come this person selling is willing to sell it at a lower price when the market price is higher?
Because the markets were not that aligned as they are today. They were not as, what's the right word? They're not as balanced as they are today, where when a market order comes today, it is sold at the electronic exchanges, at the New York exchanges and the dark pools. That time there was no dark pools. The electronic exchange were trading on their own, and the New York was trading on its own. So you were buying at New York and selling it on the electronic exchanges and making that ARB every time.
So how was that order presented to you? Like, how did you know that order existed?
So basically, the specialist has a condition which he would go to, which is called the U-court condition. So he would kind of pause the stock on New York, saying, "Listen, we are in a U-court mode where you can put out orders to buy." How many ever shares, the amount of shares that you put out would kind of change the pricing, and then he would print the price, and then you would get that price and you could flip it at the same time, or you could start shorting ECNs before that and kind of make the money already.
So as soon
Makes sense?
It does, yeah. That type of edge doesn't exist anymore. Would I be correct?
Oh, yes. Otherwise, I would not be talking to you from my office. I would be talking to you from a private jet.
You made that much money doing it, yeah?
Oh, we would, yeah. I mean, at that time, we didn't have that much capital. We didn't have the technology to do it. But, we were just sitting and just like, a big order comes in, like maybe a 100,000 share order. You would put out shares. You would get a special print, and you would just flip that to the ECNs and get out.
When you say flip that, would you flip that like almost instantaneously?
Yeah, my average in 2007, I think my average hold time was somewhere between 6 and 7 seconds.
Wow. Okay.
Yeah, it was just right. As soon as we get it, you would just get out, because you're like, listen, it's free 20 cents, could be 30 cents, could be 50, could be $1. I remember one trade I did when my coach was gone on vacation, and people made fun of me because I was that naive that I don't know if you know NVR, which is a $600, $700 stock at that moment. Today it's a $2,500 stock, but it had a U-court and it printed like 2 points below where it was trading. So I bought like 600 shares and made $1.50 on it or something like that. And I was just a newbie. I didn't even think. I said, okay, any stock, the same situation comes, you do the same thing. I didn't realize it was like a $700 stock, and making a point on a $700 stock is no big deal. And you should not be in 600 shares because it could go against you pretty quickly.
Where was the risk on that trade? Like, how could you lose money doing that?
I mean, over time, the markets get more more sensible, and there's more people doing the same thing, and there's a fight in the office because everyone wants to get out first. So the ARB went less and less and less, and then later on we just started holding that print and buying more as it went if the stock went down, because we knew there was only one big seller that actually pushed the stock down. Otherwise, the stock should be trading where it is.
How were you able to tell if there was one seller driving the stock down?
Say it again.
How were you able to tell that there was only one seller, like one big seller, who was pushing the price down?
I mean, you couldn't. I mean, usually it was one big order that came in, and then the same order could come in again and again and again and again too. But that's the risk. I mean, you could take some chances that, okay, fine. I remember in Exxon one day there was I think there were 3 orders that came in every 5 minutes. So basically, it was like maybe a mutual fund trying to get out. Back in the days, there were not that many block trades. So think about this like a block trade. So if a big mutual fund were to get out, that's how they would get out. They were like, listen, we want to sell 300,000 shares of Exxon and just sell it. Instead of a market order, do this.
Right. So was that the first strategy that you started running as soon as you came into prop trading?
Yeah, that's pretty much the first strategy I started doing when the market was still hybrid, which means that it was not fully electronic. New York still had specialists, and the electronic market had just started functioning. So there was that ARB which was there during that time, and then slowly the specialists started going, and New York became electronic, just like how Nasdaq is today. And there was no specialist. Technically, there is no specialist now too. Everything is pretty much automated.
Right. So I guess it's fair to say that you were profitable fairly quickly when you started.
Yeah. I mean, that's what I told my parents, because I didn't know what I was doing, and I was like, the job options that I will go work in a financial institution and make your $40,000, $50,000 a year, or it was doing this, which is what I loved and which I really enjoyed. And I said, if I don't make $40,000 in my first year, I'll quit the job and go back to a regular 9-to-5 job. And so the first year I was profitable, I think, in maybe after 3 or 4 months.
That's pretty amazing.
Yeah. I mean, when I look back at it, I think even a monkey could have done what I did. I mean, all you had to manage is risk, obviously, which is obviously the hardest part of trading. But at that time, it just looked so easy, and you were naive, and, you were just, the youth was there. You didn't care about anything, just like, yeah, let's just trade and, take on risk and, make the money. And, but that did have a downside, which I'll tell you later.
Sure. And do you remember how much you made in your first year?
I think my first year, I made 120,000 for the firm. Nice. So I took home about 65, 70 home.
Okay. I'm sure many traders would be happy to have a first year like that.
Yeah. No, I mean, I was ecstatic because I was like, all my friends were super smart, and they all got jobs, and they were all starting at like 50,000. And I was like, listen, man, I just paid 70,000, and I work only 8 o'clock to like 3 o'clock.
Yeah.
So it was good.
Now, you said there was a downside to this as well. Let's talk about that.
Yeah. Absolutely. And that's where everyone should learn from. And that's how I learned. And you kind of learn the hard way, obviously, in life. And I mean, what I would do is there would be these big orders would keep coming in, and I would buy them. And then if, over time you get greedy, you're like, what, I'm going to sell. I'm going to wait for the market to go back up where it is. And then another big order would come in, and I would double down. And then another big order would come in, and I would quadruple down. And then sometimes there's news. And people knew the news before we did, which, like the way it is these days, you kind of pretty much get the news maybe 15 seconds late. But back in those days, you didn't. It was insider trading to the core, and people didn't realize that, but it was. So you would get sometimes, screwed in something like this, where you would be down. So I kept doubling down, and sooner or later I saw myself, I was down like, I think 40,000 in one stock. Can't remember which stock it was. I think it was Fannie Mae or one of those companies. And, and then I had to get out because, it's not, you don't have unlimited money or risk. So I kind of got out and took a loss of about, I think, 40,000 in one stock, which was humongous because, I never made that much to take a loss of that much in one stock. And so, I kind of spoke to one of the senior traders, and he's like, listen, I mean, just keep doubling down. The doubling, I mean, you double zero, you get nothing. It's still zero. So you can never double zero. So, think about it that way. It's always good to, if you have a stop, you respect stop, get out. If you still like it, take some time, get in again. And if you don't like it, get out. So I kind of learned that the hard way. Is like, listen, you just cannot keep doubling down because I doubled down before and it always worked out. It's just one time and it doesn't work out, you kind of lose your pants. And so I kind of learned the hard way that, listen, you just cannot double down all the time. Instead, you got to get out, respect the stop. If you still like it, get in again. If you just don't like it, respect the stop, So that's what I learned, I think, the hard way. I think I remember that time, I was still a newbie. I think it was a year into trading, and I think it was like the fourth or fifth biggest loss in KTG history at that time. And it was like this newbie trader coming and losing so much money. So, my buying power got cut, and my shares got cut, and everything got cut. And I was like, man, till then I was flying, and that's what this market teaches you. You can never fly. And every time you're flying, you got to remember that, you could go to zero very quickly, and you just have to respect that. And I think I've learned it the hard way. And it's great because I learned it very early in my career. People learn this sometimes late in their career when they have kids and this and that, which is kind of hard in life. But I kind of learned it very earlier that, listen, risk management is everything. I don't think it's the ideas you have. I don't think it's, the keys you might have or anything. I think the biggest thing is risk management. If you can manage your risk, the profits will always come.
Now, when you say you were doubling down on these trades, you just simply mean you were just adding to your losers. So you're just buying, if you're long, you just keep buying at lower prices.
Exactly. And you always think, oh yeah, it's going to turn around now. It's going to turn around now, and it should turn around. Why is it not turning around? Then you start, believing in God and saying, listen, please turn around. And when you start begging, you're wrong in a trade. So that's one thing I learned. I'm like, listen, when you start begging for a stock to turn, something is wrong. You might as well get out and take the loss and accept that you made a mistake, because there's 250 other days in the year where you can come back and make that money back again. So, that's what I learned the hard way. I think it was in 2007.
So how did you feel at that time? Like, what was going through your head when you went home at the end of that day?
Oh man, I felt horrible. But I think one of the things that I've learned, and I keep telling all my friends the same thing, is that what you can feel psychologically in my job, I don't think you can feel in any other job. The ups and downs, the highs and lows, everything comes pretty quickly and can come anytime, and you never know. And you still have to survive, and you still have to come back the next day and trade. So yeah, I felt pretty bad. I went home, went to sleep, came back the next day. I said, today I just want to make $500. I don't want to make any more money. If I make any more $500, it's a bonus. And then I just kept, growing slowly. Again, you got to start at ground level again, and it's frustrating, but what doesn't break you makes you stronger. So, I wouldn't change any of those trades or any of those double downs that I did, because you learn only from losing money. You never learn from making money.
Right. And I think that was a good point that you raised, that it's better that these things happen a year in or early on in your trading career than they do 5-10 years in, because the outcome will be much more catastrophic.
And I have a story of that also, that it's happened to me later in my life too. But we'll go on with the interview. I'm sure that's going to come up somewhere.
Okay. I've made a note. So do you remember how long it took you to recoup that $40,000 loss?
I'm actually just looking at my chart from 2007 right now, and I think I was up about 64,000 when I lost that money. And I think it took me about a month and a half, maybe 2 months.
Okay, that's not
Yeah,
too bad.
it wasn't too bad. But see, again, it's like this, right? I mean, the way I look at things is when the market is hot, you can lose whatever you want. You can always, because you'll make the money back. Like last year, I would not mind being down 20, 30,000 because I'm like, listen, the risk and the reward is great. But when it's a dead market and you lose that much money, like right now, I don't want to be a part of that. That's bad trading for me. That's something which I don't want to do. And in a good market, you can do whatever you want in terms of losing money because you'll always have a chance to make it back. In a bad market, there is no chance to come back. You have to earn it, very slowly, and it's frustrating. And it's like you're not getting a paycheck, and at whatever level, how rich you are, not getting a paycheck is mentally always going to, hurt you.
How do you think about how do you think about a good market and a bad market? Like, what's the difference between those two?
For me, it's the VIX. It's the volatility in the market. I mean, like for example, last year the VIX was going crazy, especially from September, October onwards, and that's when you don't take vacation, you don't do anything, you just sit and trade all day, and you just trade. Just trying to maintain risk if you can, but if you can't, but that's where that's for me is a good market when the VIX is going crazy, when people are panicking. That's what I like.
Okay, so you perform best in high volatility conditions.
Yes, that's my trading style. So that's where I excel.
Right, and as we were talking about this $40,000 loss, I think that was around about 2007. Obviously, the GFC rolled around the following year. How did you go during that time? Was that a profitable time for you?
Yeah, I think 2008. I'm just looking at my chart right now. I think I finished the year up 813,000. That's what I made for the firm. So I think I took home about 500,000 that year. And it was just basically, I think it was September. I think it was August, September, which kind of made up the whole year for me. I think I had like $250,000 months in those two months, and it was a great year. I mean, we keep discussing between my friends who are traders out here that if we had the technology and the capital that we have today, we would have been up at least 10 million that year, because it was crazy. It was just something that I've not seen till date. It was, I don't know if you know, like imbalances, which is one more strategy which we play, is like market on close imbalances, where, there's a lot of the mutual funds will sell their stock or buy their stock at the end of the day, and whatever the closing print is what they'll buy at. And so I remember at that point, Bank of America one day, I mean, we didn't have data as good as we have today. I think printed down like 1.5 points. And if something like that happens, you would probably take at least 250, 300,000 shares of something like that. So when I look back, I was like, yeah, I mean, I wish I had the experience and that I have today. I would have, pretty much done way better than what I did back then. But at that time, it seemed like, wow, dude, like, I never paid such a check to the IRS ever. And it just felt, I'm like, oh yeah, life is great. This is, how life is going to be. You're going to make, $500,000 a year. That's a great life. But no, 2009 wasn't the best.
Okay. Yeah. Let's talk about imbalances. Is that something you still trade quite a bit?
Yeah, it's still traded, but the edge is not the same as it used to be. But once in a while you'll find something and you'll make some money off it. But on daily basis right now, it's just, I think they're better when the market is going a little crazy. The imbalances are much better because people are panicking out and people are, pushing the stock in one direction or the other. As of right now, I don't think there's much of an edge in imbalances, and slowly but surely they're going to go away.
Okay. Well, I think it would be interesting to talk about this in a little more detail. I mean, I actually don't know even really what we're referring to here when we talk about imbalances. I think we've maybe talked about it one time on the podcast, in the history of Chat with Traders, and that was way back. But when you're talking about trading and imbalance, what are you actually referring to it, and what's imbalanced?
So basically, at 3:50 New York time, NYSE and the Nasdaq will publish an imbalance in every stock. Well, most of the stocks, right? So maybe let's say Bank of America has an imbalance of 500,000. From that, 250 is not paired. That means they don't have enough sellers and buyers for the 250,000 shares. And then slowly you kind of, buyers might come in to offset the 250,000. But if they don't, then you're kind of shorting the stock, and then you're buying it at the close. Make sense?
Sort of. Why are there? So these are orders which are not posted on the market?
They're not posted on the market. They're only for the close. So basically, a mutual fund could be, listen, I want to sell 500,000 shares, or I want to buy 500,000 shares at the closing price, right?
Okay.
The closing price is determined by an imbalance that happens in the last 10 minutes of the day. So, for example, it's a mutual fund wants to sell 500,000 shares in Citigroup. So you're basically trying to be a buyer, so you can offset that imbalance. And then slowly the market will converge somewhere between where the imbalance is and where you are, where the market is trading right now. So there's a list that they will come out with, that the clearing price for Citigroup is $35.50, and slowly the price will keep changing close to where the market is trading. But sometimes it doesn't change as close to the market, and then you can kind of play that as a trade.
Okay. So at what point do you actually get filled on the trade? Only at the close?
Only at the close. You get the closing print.
And then your idea is to what? Get out in the after hours or the following day?
No. So you're basically shorting. So let's say if I'm trying to buy at the close, I am shorting before that. So I'm offsetting it right then and there. So basically, I'll short 1,000 shares, and I'll put 1,000 shares at market on close. And so you kind of offset it by then.
Okay. I'm following you. Yeah.
Yeah.
Interesting.
It's a little complicated.
No, but it sounds like a clever sort of trade.
Yeah, I mean, it used to be. Now this, if it's closing at the same price and the clearing price is the same as in the closing print, sometimes there's nothing to be made. Maybe there's 3 cents or 4 cents. But that's what it is. But, back in the day, there was like 35, 40 cents, 50 cents, and you could take a lot of size. And as I said, in 2008, some of the imbalances were humongous, because a lot of these mutual funds were like just, had to like just get out of stock, because the world was coming to an end pretty much, and they were selling huge chunks, and at that time we didn't have the clearing price data. We would check on Bloomberg what the imbalance was, and so we were kind of playing in the dark. Today you kind of have a list which comes out, and it's updated by the second. Back in the day we didn't have all that, so
okay.
There's a lot of money to be made back in the day, but we didn't have that list at that moment.
And where is that list available today? Like, does that come out on Bloomberg still, or through your just general trading platform? Like, where's that list available?
So, I mean, I don't know how we get it, but I mean, obviously Bloomberg will show what the imbalance is, but it won't update it. But I think you can get the list from New York. New York will keep updating the list, or it's sent through the broker.
Okay.
You can subscribe for it.
Right.
Yeah.
So you said that the edge is not as great as it used to be in these imbalanced trades.
Yeah.
But there are still some opportunities from time to time.
Yeah, I mean, there is. I mean, on big days like the Russell imbalance or the quadruple witching or the S&P rebal, there are like those 4 or 5, 6 days in the year where, I'm sure you'll see the volume go crazy in the last 10 minutes because, S&P has to rebalance every quarter, the S&P 500, the S&P 400, 300, whatever, and the Russell happens once a year when they will do a rebalance of the whole. I think the Russell has, I think, 4,000 or 5,000 stocks in some of them. So some new stocks come in, and Russell has to buy them, and some stocks leave, so there'll be imbalances where they'll have to sell out of some stock and they'll have to buy some stock. So you'll see a lot of these stocks moving even before the imbalance comes out, because people kind of start doing their own research and start making predictions that, okay, this stock is going to get in the Russell and this stocks are going to get out of the Russell. And there's so many other mutual funds that kind of follow what the Russell does, so they also have to buy. So it works like that. Make sense?
Okay. Yeah, it does. That's interesting, actually. So the rebalancing opportunities generally are more often or not around the index rebalancing.
Sure. Yeah. More of that. Yeah. There's some money still lying in there.
Okay. But
it can people manipulate this too. I mean, you can cancel your orders in the last minute. So let's say you'll have a big imbalance in a low volume stock, and then they'll cancel the imbalance, and everyone will get stuck in it and things like that. So there's a lot of manipulation that happens too. It's not like a straightforward money making thing.
Of course, nothing.
There is some
right?
skill to it. Yeah, nothing is. Yeah, nothing can be eventually.
Yeah, that's true. So what would you say your style of trading is today? Like, is there an area that you specialize in? Tell us a little bit about sort of the main things you're playing nowadays.
I mean, I'll usually play anything that moves, pretty much. Anything that's in action. I also play a lot of reversals. These days the low floats have been going crazy, so you kind of play those, but you need to get smart and kind of it's like a momentum trade sometimes, and sometimes it's a reversal on that. So play a lot of these low floats, play a lot of reversals. So I'm kind of looking for a big seller pushing down a stock, looking for a big buyer that's buying or pushing up a stock. So things like that. And then obviously I'll play the imbalances at the open and close. Yeah, that's pretty much it.
Okay, so reversals is a big thing?
Yeah, that's my bread and butter trade.
Okay. So can you talk to us a bit about how you might identify a good trading opportunity for a reversal?
In layman's word, I'm looking for a strong move down, and it's all. I've kind of made algorithms that kind of show me that move where a stock is moving down very quickly with a lot of volume. That I'm looking at something like that. So usually, that's why I like the wicks when it's going crazy, because people are just are selling on panic more than they're selling on news. So I'll try to stay away from news reversals, but I'll play more like the panic reversals. Like, for example, the way, the FANG stocks were behaving in November and December, like people were just selling them outright, and there was, quick moves down, and I try to catch those kind of moves and flip it and get out. So you're trying to make quick 25, 30, 40 cents and get out, and then look for more opportunities like that.
Okay. But if you're playing the reversal, are you almost trying to catch the turning point in a stock where it's been running up strong? You're trying to short it near the top. You're trying to, I guess where the top's going to come in.
Yeah, an educated guess.
Yeah. So how do you determine when to go with the trend or when to fade the move?
I very rarely will go with the trend. I only go with the trend on these new low float names, like stocks that are on reverse splits, and the floats have become so low that there's not that many people in it, and then there'll be these people on Twitter and on all these blogs that will try to push a stock up, and stocks will go crazy. So I try to play one of those things. Sometimes I'll go along with it, but eventually I try to reverse it, because my heart is always on the other side.
And how are you managing your risk on those trades? Like, it can be kind of tricky to time the top.
Yeah, obviously it is, and that's when experience comes in. I would say I'm looking at a certain criteria that if it's met, I like to be in my full size, and then I'll keep a stop. And if it goes, it hits my stop, I'm out of it. But if it doesn't, I know what my risk reward is. Like, I'll risk maybe like 35 cents to make, to at least make 55 or 60 cents.
Okay. And is there something which almost signals to you that this might be at the top, or, a turning point or reversal in the stock? Is there anything like...
I like to see increasing volume. If the volume is increasing steadily, and if the stock is falling at the same time, pretty hard, that pretty much signals to me that it's coming to an end. And then I'll look for a green bar and add in, and then put a stop.
When you talk about you like to see more volume coming in, are you referring to more volume from the sellers, like aggressive sellers as opposed to aggressive buyers?
No, I'm looking just for volume in as a whole, because I don't know who's a seller and who's a buyer. But if there's enough people buying also, that also helps, right? But it has to be, for me, volume is everything. Volume and the quickness that it falls with.
Volume and the quickness that it falls.
Yeah. So I don't want to go more in detail in that because it's tough to explain. But there's basically I'm looking at the slope, and my algorithms depending on the slope and the volume and those kind of criterias.
Okay. Are these algorithms that you've programmed yourself, or do you have assistance for that?
I have programmed myself. But I mean, it's basically my idea, but then, maybe some are programmed by someone else, but it's my idea, but the programmer might have programmed it for me.
And how do these algorithms assist your trading? Like, they don't automate your trades, do they? They just kind of signal to you.
Yes, exactly. They just show me if I then I use my own experience and my own insight, and if I like it, then I'll be a part of it. I mean, sometimes, things can, algorithms can show anything sometimes. And I'm like, oh, I don't like that. And then if I like something, then, I'm in it.
So there's a discretionary overlay to it.
Yeah, absolutely. I mean, it's not like, everything that it shows, I'm going to be a part of, because there's a lot of noise. You just have to see what's noise and what's real.
Nish, going back to earlier in the interview when we were talking about, some of the stories from the early days of your career, one of the things we kind of skipped over, and I've got a note here that I really want to speak to you about, is trading the flash crash. Now, I think, was it the 2015 flash crash was where you really hit your stride?
Yeah.
Can you talk to us about, can you share that story with us?
Sure. I mean, there's been a couple of flash crashes, to be honest. I think 2011. I think 11 had one. I think one was like, there's been a couple of.
This was the big one in 2010, I think, was the big one.
Yeah, I can't remember right now, but I think 2010 maybe. Yeah, 2010 had one, I think in May. And I did decently well on that, but you always look back like, dude, I should just kill this. We all knew it was a mistake. I think there was once when there was a flash crash, which was just a regular flash crash, like the market was just going crazy, just fell down, and you make money. And then I think there was one after that, which was a mistake where a firm went bankrupt because the algorithm just started selling all the stocks that they owned or something like that. And I remember making money on that too. But 2015 was a whole different one in terms of what happened in 2015 is obviously the market opened down like nearly, I think 600 points, and then just dropped straight, I think down 1,000 points, the Dow. And the way you can scale up so much, because a normal flash crash, you make six figures, but in this flash crash, you make a lot more, because what happened was, and I don't know if I can explain this properly, but I'll try, is that a lot of the ETFs were halted got halted. So an ETF that tracks the S&P 500, for example, or an ETF that tracks FTSE, an ETF that tracks XYZ indexes, the amount of selling in those indexes corresponded to the same selling in these indexes, but they didn't have anyone on the to buy them. So there was zero liquidity on the other side. So these stocks were halting. Now, when they were halting, which is really not ever happened, where ETFs start halting, we kind of saw that. We're like, why is the FTSE ETF down 35% when the market is not even down like 8 or 9%, right? So as soon as and what happened with them halting is that a lot of stops got triggered, and they were just, they became market orders lying as sell orders on the book because the stock was halted, the ETF was halted, and when it opened, all these orders just flashed down, right? And we kind of was waiting for all these things to open, and we just kept orders down, and we just bought as much as we could. As a firm, I mean, some people, saw that, some people didn't. People who saw it made a lot of money. I saw some part of it. So I kind of bought, 50, 60, 70,000 stocks of a ETF that trades maybe 100,000 in a day. So it was one of those things. So that's where you make most of your money in something like that, because you're not scared. You're like, listen, this is stupid. There's no way that the FTSE ETF or the S&P 500 ETF, I'm not saying SPY, I'm saying derivatives of the SPY, can be down that much when the market is not. So you kind of know that there's a mistake that's happened because there's not enough liquidity in the market.
So just so I understand correctly, the actual futures, so let's say the S&P 500 futures, or the E-mini, whichever one, was down, I don't know, 1,000 points maybe.
I think it was down, I think it was down like 7 or 8%, yeah.
Okay, but the ETFs that track these were down like somewhere up to 30%.
Yeah, 35%.
So how come?
So think about it this way, that, there's people, there's these funds which are just like, people are just selling out of the funds, retail, mutual funds, whatever. They're just selling out. They're like, listen, market my order out. And they don't realize there's no one there to buy it on the other end. People are buying on SPY and things like that, but no one is buying on these small 100,000 volume ETFs, which kind of track the same thing.
Okay.
See, this was a mistake that happened, which I think CNBC covered for exactly 3.5-4 minutes. And we were like, thank God they did, because they covered it too much. There would be some changes that would happen.
Right. So you saw all this happening. What was going through your head? You just tried to buy as many of these ETFs which were down the most?
I was just looking for every ETF. So I have a ticker which shows me halted stocks. So I was looking at all these ETFs that were getting halted, and just as soon as they would open, before even they opened, I just put orders out, like 5,000, 10,000, 15,000, 20,000, 35,000, as much as I could in my buying power. And then as soon as they opened, they just swept down maybe like 1 or 2 points more than what they were already down, and that's what we did.
So your orders were to buy on the open, like as soon as that stock came out?
No, I bought some at the open, and then I kept some just on ECNs below that, because I knew that as soon as it opens, there'll be so many stops that have triggered when this market is has fallen, that it's going to create a cascade effect. Because think of thousands of orders getting stopped because the stock is halted and no one knew what to do if an ETF halts. Basically, if the way New York works, if a stock has moved, I think 10% in 5 minutes, they halt it for 5 minutes. I should have said that first.
Okay.
Right. So that's what happens. They halt it and then they reopen after 5 minutes so that people get their senses back or whatever, and they can rethink if the stock is worth buying or selling.
Were you nervous going into this trade, or did you feel very confident that this was going to play out for you?
Always nervous because, it doesn't work out. I mean, it's not working out in the start because, it's still falling, even though it should not fall, but it's still falling and you're still buying. But that, I know if this goes on for long, something is going to go, something is going to give, I mean, it has to turn around. I don't know if it's going to turn around today. At that moment, you're thinking like that. Maybe it's going to turn around tomorrow, maybe day after, whatever. But I know for a fact that this is wrong, what is happening. So I think I was down maybe the most. I think I was down 250,000 for maybe like a minute. So you're scared that time.
Yeah, that would be terrifying.
It was. But then, one of our senior traders, who's one of our best traders, and he was down, I think, 4 million. And I know my CEO asked him, "Hey, how you doing? Are you feeling all right? Are you okay?" He said, "I'm feeling fantastic."
Wow. Okay.
So I was like, okay, if he's feeling fantastic, I should not feel sad about being 250 down.
So did you just completely max out your limits on that trade?
I think as a company, we maxed out our whole buying power. I think which was about half $500 million.
Really?
Yeah. Our brokerage company called us saying that what is happening, because I think we margined so much and we kind of everyone was all in on everything because we knew it was a mistake what was happening. But at the same time, you're scared, So everyone takes as much risk as they think they can. So
was there any thought about what if this did go wrong? Like, what if this didn't work out?
I'll be okay with that. It's one of those trades where you say, listen, if this doesn't work out, I think my winning chances were about 95%. That 5% risk, I don't mind taking on a day like this.
Yeah, because it's a rare opportunity, right?
It's rare. I mean, I know people who made money on options where, like the SPY options, like the SPY, people bought it like at 5 cents for, and made and by the end of the day, I think it was trading at like 15 or something. It's like that, $15. So
damn.
A lot of things went crazy. A lot of things. I think my biggest trade was in I think Home Depot. I think I had 50,000 shares. I think I made like 650,000 on that.
Just on that one alone.
Just on that one, because Home Depot just crashed. I think it fell 30 points in I think a minute.
Okay, so you bought a whole lot of ETFs and you also bought some individual names as well.
Yeah, I did.
Okay. How quickly did these stocks snap back?
By 9:30, everything was over.
That quickly?
So in an hour, 45 minutes. And we were just hoping nothing breaks. That's it. That was the biggest. I called my wife. I said, please, any God that you believe in, please start praying that nothing breaks. I don't care about anything else. Just, if we can survive the next 2 hours, everything is going to be good. But yeah. So man, that was that.
That's crazy. Can you say how much money you made on that day?
I don't want to say the real figures, but it was 7 figures.
Okay. Multiples of 7 figures?
Multiple. I don't know. Multiple. I mean, it was mid 7 figures. Yeah, low 7 figures maybe.
Well done, man. That's awesome.
Yeah. But that's my biggest day by far. I mean, I think, and that's probably one of my biggest single stock winners by far, I think.
Mm. Did your views on trading change that day? Like when you left the office, did you?
So one thing I should say before that is that to do a trade, to be that confident on a flash crash like this, it takes 2 earlier flash crashes where you look back and you're like, dude, I should have done way better than this. It was there and you didn't take as much, you should have just gone all in on those things because it was a high probability that things are going to turn around. So I think when this third flash crash came, I was way more ready and confident on it. And the story I was telling you that I should tell everyone is the story in 2014 And it was a great year for me to start with. I was up, I think I was up 300,000 in the first 3 months. And it was a great start to the year, and I was really happy. I was having my first child, and my wife was like, "Oh, we need to buy a stroller." I said, "Yeah, buy the best stroller." And I was like, "We need to buy this and buy the best." Listen, it's going to be a good year. Looks great. And then I was playing an imbalance trade, just like I normally do, but for some reason I didn't get my closing print on it. So I was in 10,000 AMGN. And I was short 10,000 Amgen, which I was supposed to cover at the close, and something happened and I couldn't cover it. And it was Allegren, sorry, yeah. And I couldn't cover it. And while I was trying to get out post-market, Ackman came and said that he wants to buy the stock for $150 or $140 a share. And the stock was trading that time at about $90. And so even it took me less than, I think, in 30 seconds, I was down 300,000 in the stock.
Shit.
Yeah, it was crazy. I was just sitting at home and trading, and basically I lost everything I made for that year. And I mean, just the loss itself was really hard psychologically. I just had a child. It was just, I think it was 15 days after that, and I just couldn't believe what happened. I was still in a daze. I think when I came down, I thought of quitting trading, because I was like, I don't know if I could ever come back from a loss that big, or how long would it take? It was just like my whole life was like coming in front of me, and I was just like, I don't know what to do at that moment. It was a tough time. I was pretty much in tears. I called my old coach, and he kind of told me, he's like, no, just stick in there, just don't worry about it, just just hang in there. And I was like, okay, fine. You know what, this is the reason I started trading, is because I love trading, and it's for the passion of trading, because this is what I would do every day of my life if I had a chance. I would work on weekends if there was a short of trading on weekends. So I said, you know what, let's just go back to the love of trading and forget everything else. And I started trying to make a small comeback. I think I remember the next month I lost $15,000 because I was just not there mentally. Then slowly I think I started making, I think made like $5,000 and $10,000 and $7,000, $10,000. Kind of slowly started chipping in on that loss, and then I think in about 3 or 4 months I found out my father had cancer, so I had to go back to India. So I went 3 or 4 times to India, and I was like, dude, what else can the world throw at me now? It's like this loss. I just had a child, my first child. My father had cancer, so he passed away in December. And by that time, I was still flying in and out of Austin to Bombay. So I didn't have enough time to even trade properly. I was still, there was so much happening at that moment. So I kind of, I think by the end of the year, I think this loss happened in April, and by December, I think I had covered about half my loss. I was down still 150 for the year. Didn't make a paycheck, nothing. And then comes 2015. So I think it was 24th. Or 21st of August. So yeah, 21st of August is when I finished my loss of 150,000. So that's when I covered all my losses, and then 24th is when the flash crash happened.
Oh, right. Okay.
So you can imagine the emotions that I was going through at that moment in life, because I had this crazy loss. It took me about 1.5 years to recover. And I just recovered about 3 days before the biggest day in my life.
That's crazy, man. There's like there's something to that story. Like, you were very close to giving up, but 12 months later, you have this massive win on the flash crash, which is like, just makes your whole career pretty much.
Yeah. I mean, then you're like, okay, at least, now you have enough money to survive in trading, because, I mean, if you don't have money in the bank, it's just so hard to trade. the way you want to trade. So I always tell people, like, listen, get a second job, do whatever you want, but keep some money in the bank so that you have that confidence. You're psychologically, you're strong, and you don't rely only on trading income, because for a while it's so hard. Trading is such a hard thing because psychologically, mentally, everything, it can screw you up pretty badly, And for me, it was like, that was it. I mean, for me, it was like that whole 15, 16 months ordeal ended up with the high of my life, So you learn a lot from all that, because I'm like, I was pretty much in tears after that big day in 2015. I called my wife and I'm just like, what a circle this has been and what it's taught me, And I had some big days before that. I remember like my first big day, I think it was in 2007. 2007. It was a big day because I made $100,000 in one day. And I told all my friends, guys, we're going to party tonight. Listen, I was like 20, 24, 25. I was like, dude, this is like, who makes 100K in a day? This is like epic,
Second year into trading.
Second year into trading. Forget second year. Never seen that kind of money in my life. So I'm like, listen, party guys, let's go out and let's drink. So I got everyone to a restaurant, just ordered champagne, whatever people want to order. I said, order, guys. And obviously, we're all drunk and this and that. I think I spent I think $1,200 that night just, buying drinks for all my friends. And then, my biggest loss is obviously in 2014 when I lost 300,000. And I'm just like, obviously your friends are there for you, but, no one is giving you the $1,000 back when you want it, So
yeah, it doesn't work that way.
Yeah. So you kind of learn in life that, listen, let's not celebrate the lows. Let's not celebrate the highs, and let's not, frown about the lows. Everything will come when the time is correct. Just work hard and, have the passion for trading, which I think is the number one thing for a trader. If you have the passion, you'll do well. The money will come automatically. And I've always believed in that. So when I had this big day also, I didn't celebrate. I just went home and I said, Sanal, to my wife, I said, let's have a drink, and that's it.
Yeah. Good stuff, man. Let me just ask you one more question.
Sure.
I guess it kind of ties in with this. Just on to a less extreme, just day-to-day kind of trading, is there anything you do to help with your psychology? If you have a few losing days in a row, it can kind of be a bit of a blow to your confidence. And then if you get on a hot, a winning streak, you can also get a bit overconfident as well. Is there anything you do just kind of day to day which helps balance out your psychology?
So Aaron, you actually caught me on the right day. Today is a day when I've lost 2 days in a row, and I've lost pretty much, I think I lost 50 today and I lost 28 yesterday, which is a pretty big loss for me, seeing the way the market is going. So I'm pretty low on confidence right now while I'm talking to you, to be honest. And I was actually going to cancel the interview today because I was like, you know what? I just have no mood of talking to anyone. In fact, I don't want to see anyone. I just want to go to bed and wake up. But I said, you know what? It's just, if I was up 50,000 today, would I still want to talk to you? I was like, yeah, for sure, I want to talk to you today because I made 50 grand. So why should anything, why should losses make you feel bad, and why should a big day make you feel great? It's just, let's just be as zen as possible. So I try to be as zen as possible and say, listen, let's do an interview, let's do the podcast. But what I do, I don't know. I did go back to the basics. I say, listen, why am I doing this? Because this is something that I love doing. I would do this on weekends. I would do this every day of my life because this is what I love doing. Okay. And I can only do things in my life that I love. So I'm a DJ and I'm a trader. So there's two things I do, and I love both of them. So I would do that on any day, and then cricket. There's three things. Cricket is one more thing which I love playing. So there's three things that I love, and I'm like, listen, you know what? Even if I was losing money, I would do the same thing. Even if I got out on a duck, I still want to go and play at the next game and still want to succeed. So, I've had 2 bad days. And I've had a great streak from last year. I think this is this might be my first down month in maybe I would say maybe in 16, 17 months or maybe 18 months, So I don't know. You just have to wake up the next morning and say, listen, this is what you love doing, and just go do it. And just for me, sometimes if I'm trading badly, which is what I'm doing right now, because my biggest problem in life is overconfidence, and I get overconfident very quickly. And that's my biggest problem. I know it and I can see it. So I try to say, listen, you know what? This is, put me back to, ground zero. Time to start making $1,000 tomorrow, $2,000, $3,000. Let's just try and, try to look for the best setup. If there is none, do not trade. The good trades will come. Things will come. Just wait and be patient. I think the last 2 days I have not been patient enough because I'm like, there's nothing happening in the market. It's kind of a little dead on the way I trade. And for me, I'm trying to, if there's one thing that's moving, I'm just like jumping on that one thing because there's nothing else that is happening. So I'm just trying to, and because I had a good year last year, I feel weird that I'm not making as much money as I was making last year. So I kind of self-analyze myself. And I know that this is the reason why I'm doing X, Y, Z. So you know what? So, just think again. I mean, I know I have the talent. I've traded for 12 years, so I know there'll be good trades where I can make the money back, and I will make the money back. It's just a matter of when and patience. Which is two things I lack. I lack patience, and I'm overconfident. So people start asking me numbers and how good a trader I am. It's a good chance next day I lose money. I'm serious. That's how it is. And so I hate talking about, I love people saying, listen, you couldn't make money that day, you suck, things like that is better for me because I'm out to prove myself then. But if people say, oh, you're the best trader and oh, you do such, you make so much money and this and that. And I'm like, listen, man, please do not tell me all that because, for me to be overconfident, it's so easy.
Yeah, exactly, man. Well, I think you've shared a lot of really great insight during this conversation we've had, and it's been a lot of fun. I've really enjoyed it.
I hope so. This is things that people can learn from my mistakes and make less mistakes of their own. But in the end, they will make the mistakes, and if you can learn from it, great. If you can't, then you won't be a trader.
Yeah. If someone wants to find out more about you online, I know you don't have a great online presence, Nish. I know you're on LinkedIn. Is that the only place? You're not on Twitter or anything like that, are you?
No, I mean, I am on other platforms. LinkedIn is one thing I'm not on because for 12 years, this is my first job out of college. I've never had to build a resume or needed anyone to get in touch with me for any reason. So I've never had to really update my LinkedIn. I don't even know what's there on LinkedIn, to be honest.
It is there.
It is there, right? Yeah, okay. Maybe it was there when the whole fashion of LinkedIn profiles were there, and I'm sure I made one. But I'm there on Instagram. I'm there on Twitter. I'm there on Facebook. But it's all my DJ stuff basically because I'm also a DJ. So I kind of promote myself more on Facebook and Twitter and Insta. But none of my trading stuff is there. it's all the DJing stuff.
Yeah, cool. When do you do the DJing thing? Like after hours on the weekends, that kind of thing?
Yeah. Friday night, Saturday night, I throw my own Bollywood parties in Austin, and I do a lot of weddings and this and that. And I still do it for the money, and because I like to do it, obviously. But the money is one of the reasons. And I keep telling people that's the only constant income that I have because I don't know what the market is going to do tomorrow or day after, or if I'm going to lose 100K or make 100K. So this is something which is constant, and till money comes into my account, I'm happy, even if it's 500, even if it's 1,000, because if I make money in trading, that's great. So now I'm trying to invest a lot of my money in different projects so that there's a regular stream of money that comes in, and I don't have to depend only on the way what the market is doing, because you can't have your life depend on something which you can't control. Yeah,
that's really cool, man. So feel free to share maybe your Twitter handle and your Instagram handle.
I think my Instagram handle is DJNish80X, and my Twitter handle is Nishant82, I think. I'm always on Twitter, but I never really tweet. But I only tweet when I'm losing money in a trade. I'm like, hey, listen, guys, check out this stock. So I think it's at Nishant82, and then you can find me on Facebook at Nishant Porbanderwalla or DJ Nish. You can find me on Facebook on that, and pretty much there's no one. I mean, there shouldn't be anyone on Twitter who tells you how to trade or how to make money, because no one should be doing that. And if someone is doing that, it's a propaganda on their own. So that's something which I believe in. I feel like no one writes books on ways you can make money in trading, because why would you? You can write about the psychology of trading. You can write about risk reward. You can write about all that stuff, but I don't think you can write about ideas about how to make money in trading.
Right. Ultimately, it comes from your own experience. Yeah.
Yeah, it's your own experience. It's. I mean, I think I've had about 10 or 12 students, and only 2 are kind of still actively trading. And I really don't understand what it takes to be a trader, to be honest. But I know the retention rate in my company is probably about 12 or 13%.
Really?
It's that low. Yeah, it's really hard, I think, to be a trader in this market. I think so.
You think that retention rate would be a lot higher if it was, back in 2006 when you started?
Yeah, I think it would be much higher. I think it was in the 30s when I started, 35%, because it was much easier to trade. Today, you got to wait for the right market. And it's been a bull market, for the last, until 10, 11 years. And it's tough to trade in a bull market because the volatility is so low in those markets. So when there's volatility in the market, we do really well as a firm. But when it's not, then it's you try to make ones and twos. You're taking ones and twos and trying to make a couple of thousand here and there, so you can survive and wait for the right moments to come.
Well said, Nish. Let's call it a wrap. Again,
sure.
I'd like to thank you for doing the podcast. It's been a lot of fun, and I appreciate.
No, it's been fun on my end too. Yeah, thank you so much, Aaron, for having me on your podcast.
Very welcome. Thank you.
Take care. Cheers, buddy.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.